Investing isn't just about making money, it's about keeping it. Let's expose three of the most dangerous investing mistakes that could quietly sabotage your financial future. Investing is one of the most powerful ways to build wealth, but it's not always easy. Many people dive into the market hoping to grow their savings, only to find themselves frustrated by disappointing results. Why does this happen? Often, it's not about picking the perfect stock or timing the market just right. Instead, it comes down to avoiding costly mistakes that can quietly drain your portfolio over time. The good news? You don't need a finance degree to succeed. You just need to recognize some of the most common investing pitfalls and take steps to avoid them. In this video, we'll explore three of the biggest investing mistakes people make, based on real data and expert insights, and how you can steer clear of them. Chapter 1. Trying to time the market. Have you ever thought about selling your stocks when the market drops, hoping to buy them back cheaper later? If so, you're not alone. This strategy, called market timing, sounds smart, but it rarely works in real life. Here's why. The stock market is unpredictable, often swinging up and down without warning. Research shows that from 2004 to 2024, if an investor missed just the 10 best trading days in the US stock market, their portfolio's value could have been cut by more than half. Even more surprising, 7 of those 10 best days happened within 2 weeks of the worst days. This means that by selling during a downturn, you might miss the critical rebounds that power long-term returns. Market timing is difficult, even for experienced professionals, let alone everyday investors. Behavioral finance experts attribute this to emotional biases like fear and greed, which can cloud judgment during market turbulence. Fear prompts investors to sell when prices are low, while greed pushes them to chase hot stocks when prices are high. Both harmful behaviors. So, how can you avoid this trap? First, adopt a long-term mindset. Investing isn't about predicting short-term market movements. It's about staying invested through both ups and downs. Historically, the stock market has delivered positive returns over time, despite regular downturns. Second, consider using a strategy called dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you buy more shares when prices are low and fewer when prices are high, reducing the impact of volatility. Lastly, resist the urge to constantly check your portfolio. The more you monitor short-term swings, the more likely you are to react emotionally. Instead, set clear financial goals and stick to your investment plan, even when the market seems chaotic. Market timing may seem like a winning strategy, but history and data prove otherwise. The key takeaway? Stay invested, stay consistent, and let time, not timing, work in your favor. This approach could save you from costly mistakes and keep your financial goals on track. Chapter 2. Lack of portfolio diversification. Imagine putting all your savings into one stock, hoping it'll skyrocket. While tempting, this is one of the riskiest investing moves you can make. Lack of diversification means your entire portfolio hinges on the success or failure of a single investment. If that stock crashes, your savings could vanish overnight. Data shows that in 8 of the past 10 years, most stocks in the Russell 1000 index underperformed the index itself. This proves that even popular stocks can struggle while the overall market rises. Betting too heavily on one stock, sector, or asset class exposes you to unnecessary risk. Overconcentration can happen in unexpected ways too. For example, many people unknowingly hold the same stocks across different mutual funds or ETFs. Others accumulate large amounts of their employer's stock through compensation packages. While loyalty to your company is great, tying your financial future to its success is risky. So, how can you fix this? Start by diversifying across asset classes, such as stocks, bonds, and real estate. This helps spread risk because different investments tend to perform well at different times. If stocks dip, bonds or real estate might rise, cushioning your losses. Diversification within asset classes matters too. In stocks, include companies from various industries like technology, healthcare, and finance. Consider adding international stocks to tap into global growth. Avoid having more than 10% of your portfolio in a single stock, even if it's your employer's. Rebalancing is another crucial step. As investments grow at different rates, your portfolio can drift from its original target. For instance, if your tech stocks surge while your bonds lag, you may become too exposed to tech. Rebalancing means adjusting your portfolio back to its intended allocation. Many financial advisors recommend reviewing your portfolio at least once a year. Finally, don't overlook index funds and ETFs. They offer instant diversification by spreading investments across hundreds of companies. These funds also tend to have lower fees compared to actively managed funds. The bottom line? Diversification is like an investing safety net. It won't guarantee profits, but it can reduce the impact of market downturns and give your portfolio a smoother ride toward long-term growth. Don't let overconcentration sink your financial future. Diversify, rebalance, and invest wisely. Chapter 3. Ignoring investment costs and taxes. When it comes to investing, it's easy to focus on returns while overlooking hidden costs. Fees, expenses, and taxes may seem small, but they can quietly eat away at your portfolio over time. Understanding and managing these costs is critical for maximizing long-term gains. Let's talk about investment fees first. Actively managed funds often charge high management fees, which can reduce your returns. According to financial experts, even a 1% annual fee can cost you tens of thousands of dollars in lost growth over decades. Index funds and ETFs typically have much lower expense ratios, making them cost-effective options for most investors. Transaction fees are another hidden cost. If you frequently buy and sell stocks, commissions and trading fees can add up fast. The same goes for short-term capital gains taxes, which apply when you sell investments held for less than a year. These gains are taxed at higher rates than long-term investments. Taxes can also impact your investment returns through what's known as tax drag. For example, if your portfolio generates income or capital gains, a portion of those earnings may be taxed, reducing your net returns. This is where strategies like tax loss harvesting come into play. By selling underperformed assets, you can offset taxable gains from other investments, boosting your after-tax returns. Using tax-advantaged accounts is another smart move. Accounts like IRA, 401ks, and health savings accounts, or HSAs, offer tax deferrals and even tax-free growth, helping your money compound faster. Be sure to contribute as much as you can to these accounts within legal limits. Lastly, consider consulting a financial advisor who understands tax-efficient investing. While advisors charge fees, the savings they help generate through strategies like customized tax planning can often outweigh those costs. In the world of investing, every dollar counts. Reducing fees, minimizing taxes, and using smart strategies can make a huge difference in the portfolio's long-term success. Don't let hidden costs quietly drain your wealth. Take control by staying informed and making tax-smart decisions. Chapter 4. Final thoughts. Investing isn't about making perfect moves. It's about avoiding costly mistakes. Today, we explored 3 of the most common investing pitfalls: trying to time the market, failing to diversify, and ignoring investment costs and taxes. These errors can quietly chip away at your financial future if left unchecked. The good news? You can avoid them with a few smart strategies. Stay invested for the long haul instead of chasing market highs and lows. Diversify your portfolio across assets, sectors, and even global markets. Finally, be mindful of investment fees and use tax-saving tactics to keep more of what you earn. Small adjustments today can lead to big results tomorrow. Take action. Review your portfolio regularly. And don't be afraid to seek professional advice when needed. Investing success isn't about luck. It's about making informed choices and sticking to a well-thought-out plan. Start now and let your money work for you. That's it for the video. Don't forget to like and subscribe, and we'll see you in the next video.